Hello, my name is Audra Wilson Russell. I am the owner of myaccountingcrew.com, and it is my pleasure to speak to you today about estimated tax payments. Just a little bit about myself. Like I said before, I'm the owner of myaccountingcrew.com, originally established in October of 2012, although we have gone under other business names since our inception. The actual legal name of the company is Wilson Accounting and Tax Services. So for a little while, we went under Wilson Accounting and Tax Services to Watt CPA. And then at the end of, I want to say 2001, we officially changed our name to myaccountingcrew.com as our DBA. I am a certified public accountant in the state of Florida. I hold a bachelor's degree in accounting from Florida State University, as well as a master's of business administration from Lynn University. I am a QuickBooks Online Pro Advisor, as well as a Zero Accounting Certified Advisor. Jumping into the topic of today's discussion, estimated tax payments. What are they? So, what they are taxes. Oops, sorry about that. Taxes must be paid as you earn or receive income during the year, either throughout withholding from a paycheck or estimated tax payments that you make yourself outside of your W 2 withholdings. Estimated taxes is a method used to pay taxes on income that is not subject to withholding. So if you are receiving income throughout the year that is not on a W 2 or not on a 1099-R or through Social Security where you're able to have the taxes withheld on it, then the IRS is going to expect you to make your estimated tax payments yourself. So let's talk a little bit about who has to pay estimated tax payments. Individuals, sole proprietors, partners, and S corporation shareholders generally have to make estimated tax payments if you expect to owe taxes of $1,000 or more when you file your tax return. And this is for income that could include interest, dividends, alimony, self employment income, capital gains, prizes and awards, and unemployment compensation. So, as a general rule, you will have to make estimated tax payments again if your tax debt is $1,000 or more. And this is after you subtracted how much you've paid into the system through withholdings, subtracting any refundable tax credits that you may receive on your tax return. And if it's still 1,000 or more, and you expect your withholding or your refundable credits to be the smaller of the two, which is 90% of taxes shown on your current year return or 100% of taxes from your prior year return. So you kind of have to know what your tax situation is to really know if you're required to make those estimated tax payments for the current year. So we can't talk about estimated tax payments without first talking about self employment tax. So, what is self employment tax? Self employment tax is 15.3% of the net earnings from your self employment business. It's a combination of Medicare and Social Security taxes. Now, I will say here that net profits from S corporations are not subject to self employment taxes. I may do another video on this because that is one of the major reasons why people decide to transition their LLC into an S corporation for tax purposes because they're saving on the amount of self employment taxes that they have to pay. But there are a few caveats with doing so. So just keep in mind that S corporation shareholders do not pay self employment taxes on the S corp net earnings. So, who must pay self employment taxes? You're required to pay self employment tax if your net earnings from your self employment was $400 or more, or if you are a church employee with income of $108.28 or more. So, you're required to pay self employment taxes if you are a sole proprietor, such as a consultant or independent contractor. If you have a lawn business, a hair business, nail, if you're independent or sole proprietor, and this includes single member LLCs and also businesses who are DBAs. If you're not quite incorporated, but you're working under a doing business as, those are still considered self employed individuals. If you are a partner in a partnership, you're required to pay self employment taxes. And if you are a household employee, you're required to pay self employment taxes. Again, S Corp shareholders do not pay self employment taxes. So I mentioned that the self employment tax is 15.3%. So let's break down what makes up that 15.3%. Think back to when you were a W 2 wage earner, an employee of a corporation. Let's just use Target for an example. At the end of the year, when you get your W 2 from Target, you'll have three buckets of taxes taken out of your paycheck. Technically, four if you're in a state with state income taxes, but we're just focused on the federal level here. So, boxes 2, 4, and 6 of your W 2 will show your federal withholding from your paycheck. Box 4 will show your Social Security withholdings, and then box 6 will show your Medicare tax withholdings. That box 4 is 6.2% of your income, and box 6 is 1.45 of your income. The total together is 7.65 of your income is being taxed for Social Security and Medicare. That's as an employee. When and in this case, your employer, Target in this example, will pretty much have to match what you're paying to also pay to the government. So there's your bucket of Social Security and Medicare, and then there's Target's bucket of Social Security and Medicare. And both of those buckets will go to the government. Well, when you're self employed, you are now the employee and the employer of your business, per se, both the employee and the employer. So you get the great opportunity of paying both buckets as self employment taxes. And those two buckets combined, Social Security and Medicare, employee and employer, is pretty much what makes up the 15.3% of self employment taxes. Now, where is that reported? On the actual tax return. If you file a Form 1040 where there's taxes calculated here, line 16 would be actual federal income taxes. And then line 22 under other taxes is where the actual self employment taxes will go. So think of line 16 as the equivalent to box 2 of your W 2. This is your federal withholding. And then box 23 would be the Social Security and Medicare times two. That is where your self employment taxes gets reported on your personal tax return. And again, an S Corp shareholder will not see self employment taxes here for net profits from that business. So, how do you calculate how much you actually owe in estimated taxes? So, there's a very quick and easy way, but it's a little bit riskier because you do run the risk of underestimating and then sometimes overestimating and paying too much into estimated tax payments. Paying too much could be great if you don't mind receiving a refund at the end of the year for the overpayment. Underpaying your taxes could you could run into a situation where you're penalized for not paying enough. So that's why I say it's the riskier way of calculating it. And then we also have the detailed and more accurate way of calculating your estimated tax payments. So let's jump into a very basic, quick and easy, little bit risky way of calculating those estimated tax payments. So to do that, you're going to calculate your net profit from your self employment income. And that could be done through your accounting software. Your accountant may provide you with this information. Or if you're old school and you don't have any accounting, at the very least, an Excel spreadsheet where you are tallying up your revenues and your expenses. So once you tally up your revenue and your expense for the period, you're going to come to what your net profit is for that period. And I'm using very simplified numbers here for illustration purposes. Revenues of 100K minus expenses of 75. So our net profit slash net income is going to be 25,000 for the period. This could be a month, this could be a year. I'm just saying it's a period and giving you a way to calculate based on that period how much you should set aside or pay in to estimated tax payments. So once you've figured what your net profit is, you want to identify what tax bracket you land in. And that's going to be based off of your own personal tax situation. Are you married? Do you have any dependents? If you are married, are you filing a joint return or are you married filing separate? So you have to go to the IRS tax tables to find what your tax bracket is to determine what tax rate to apply that net profit to. So in my example here, I believe we fell within 25,000. We're going to do, we'll say married filing joint. So we're looking to fall within that 12% tax bracket if we're doing married filing joint at 25,000 for income. So we're going to say 12%. So once we've done that, we're going to add our federal income tax withholding to that 15.3 self employment taxes because now we're looking at two separate taxes, two separate buckets of tax. You still have your regular federal withholding taxes to pay on top of the self employment taxes. So, yes, the federal income tax doesn't go away. So, once we add those together, what I like to do, and this is why I call it a risky kind of way, is I will, depending on the client's tax situation, their personal tax situation, if they're one that has a lot of deductions, they have dependents, they have credits, all of that stuff, their tax rate could very well be 12%, but the effective tax rate could be reduced by different deductions and credits that they may be entitled to. So it's not a true 12% or 24% or whatever tax bracket that you may end up in. So I do reduce it by about 5%, give or take. So instead of taxing the entire amount by 27%, I'll reduce it by 5 to tax it by 22%. And again, this is going to be based off of your personal situation. And so you're going to take that amount and multiply it by the net profit. So in this example, we're taking that 22% and we're multiplying it by that 25,000 to come to 5575 for, if that's a month, if that's a quarter, whatever the period is. This is how much we're going to pay into estimated tax payments for the quarter, or this is how much we're going to set aside if it's for the month until we're ready to pay the quarter. Now, to do a very detailed calculation of it, it does require proper tax planning and tax projections, because what we're doing is we are pretty much doing a tax return before it happens. We need to project all the puzzles of the tax return before it happens. So this includes, we need to know what your projected wages are, what you project to withhold, and not just you, but if you're married, we need to know that for you and that for your spouse. Any interest income, dividends, capital gains, self employment taxes, net profit from self employment, tax credits, deductions that you take, any rental income, any retirement income. We need to know everything that you expect to happen for the upcoming year so that we can project it and see what the projected tax liability would be, and then make our estimated taxes that's a little bit more fine tuned based on the projections. For this, one size does not fit all. There's going to be unique factors in determining your tax liability, again, like your marital status, if you have any dependents, any credits, deductions, withholdings, wages, and income. Everybody is different. So putting this all together is really truly like preparing a tax return before it happens. Good news about self employment taxes is that 50% of your self employment taxes are deductible. So, thinking back to my Target example, the buckets that Target have to match for their employees, that amount is deductible as a payroll tax expense for the corporation. So, as a self employed person, you would also be able to deduct 50% of your self employment taxes. Now let's talk due dates. Due dates of your self employment tax, of your, I'm sorry, estimated tax payments, which in part is mostly self employment taxes. For your January through March net profits, your due date is going to be April 15th. For April and May, it's going to be June 15th. And then for June, July, and August, it's September 15th. For September, October, November, and December, it's going to be January 15th of the next year. Don't ask me why it doesn't really follow a calendar quarter. It's just weird like that. The April 1st payment is going to cover the first 3 months, and then June, the next 2 months, September, I believe, but that's June, July, and August, 3 months, and then 4 months for the January 15th payment. How do you make those payments? You may receive vouchers from your accountant with predetermined estimated tax payments, and those tax payments were probably derived from your prior year tax return based on what your actual taxes were for that period, and paying 100% of that split into four different payments. So that's another simple and easy way to pay into estimated tax payments is based on last year's actual tax, paying 100% of that. And so you may have received four vouchers with equal payments from your prior accountant with those predetermined amounts. You can easily mail those in with a check or go online to make the payment. I always recommend paying online because it's faster and it doesn't have to touch hands, and with the IRS with opening mail and seeing they received things and they didn't receive this, it's just a nightmare with the amount of mail the IRS has to open right now. So I would always recommend making online payments over sending in a paper check, and I would never ever 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 send cash to the IRS or really to anyone through mail. So, how to make those payments? Go on to irs.gov/payments. You're going to click the make a payment button, and then it's going to ask you, what are you paying for? You're going to select the estimated tax as a reason for payment, and then the 1040 ES, which stands for estimated taxes. And then for the tax year, you're always making those estimated taxes for the year that we're in. So right now we're in 2023. If you're making estimated tax payments, it'll be for the year 2023. So just a little bit about my company, myaccountingcrew.com, and the services that we offer. We specialize in outsourced accounting, business tax preparation, and advisory services for small businesses. I won't list them all, they're here. You can pause the video to take a look at the different services that we offer. A good fit for us would be small business owners who wants to outsource their accounting department pretty much. We a client that won't be a good fit for us is someone who's looking for tax only services. If you do have any questions about estimated tax payments or you want to learn more about our services and what we offer, feel free to head over to our website at myaccountingcrew.com/appointment.